Hi Beth, this is Riddhi with Prospect Mortgage. Terry and I were speaking earlier, and he mentioned that you guys are trying to buy a short sale, and the short sale negotiators are suggesting that they will also try to negotiate 3% closing cost credit for you from the banks. And if you get that 3% credit, then you will owe them the 3%. So, what essentially they are saying is they will, even though they will negotiate the closing cost credit and they will help you get the house, it is not going to cost you anything because it's going to be coming from the credit that the bank is going to give you. So I'm going to do two closing cost worksheets for you that tell you exactly how that 3% of the money is going to be used. One option shows that if you get that 3%, your money, that the amount of funds that you need to bring to the closing will go down by that amount. And then the second option, obviously there is no credit, so you will have to bring the entire amount and we will not see that credit. So I'm going to walk you through line by line, and then both the closing cost options, the only difference will be that 3% credit and how it will reduce your bottom line at the closing table. The only thing I want to remind you, and that's one of the reasons we do this closing cost worksheet, is we want to make sure that you understand if you're getting a closing cost credit per FHA ruling, you have to use the entire amount. If you don't use the entire amount, whatever amount you leave, let's say the credit is $5,000 and your closing costs only add up to $4,500, you will not get the benefit of $500. You would have to leave it because FHA does not let you walk away with any credits that you haven't been able to use. So our goal is going to be to use the entire 3% that the debt negotiators are negotiating on your behalf. Can we do that? Yes, and I'm going to try to show you that. Now let me walk you through this closing cost worksheet. Again, is a good worksheet to keep in mind because it will also give you an idea as to how much money you need to bring to the closing. So let's walk through this line item by line item. Our purchase price is $145,000. We're doing an FHA 30-year fixed. I'm going to assume that's the product we had talked about, what we are going to do. So your down payment is $5,040. So our loan amount comes to $139,925, and we are going to get 4.75. This is what is available today. Again, keep in mind rates change every day, and I think you and I discussed that you will obviously get whatever the best rate um, is the going rate of that day. You had excellent credit, so I am sure you will qualify for the best mortgage rate that's available today or on the day that we're ready to lock. You can only lock once your contract is fully executed, and you can lock for the maximum of 60 days. So we'll come back and talk about that later, but that's the rate we are going to use. And we are doing 30-year fixed FHA. Our amortization is for how many months the loan is going to be paid over. That's 360 months or 30 years. Now this is the breakdown of the payment here. Your monthly principal and interest payment is $729.92. That's based on $139,925. Keep this in mind, it's a little bit off, and I'll show you why it is off just by maybe $7 or $8. But the reason it is off is because we are not adding the MIP or the upfront mortgage insurance that FHA charges on every product, and it gets just rolled into your own amount. I'll show you that in a later line item. So your hazard insurance or your homeowner's insurance is $65 a month. That's an estimate. I'm estimating it's going to cost you around $780 in your insurance premium for the entire year to insure that property. If it is less, obviously you will have a smaller number in this line, but if it is more, you'll have more. But $65 is a very reasonable. In fact, in my opinion, I'm being generous. You'll probably look somewhere between 50 and 65. Your real estate taxes per month are going to be $459. That's based on $5,500 a year that Terry told me that your house is going to be. This is the mortgage insurance. It's $140 every month. FHA's factor is 1.15. It doesn't matter which lender you use, as long as you're doing an FHA mortgage, this is going to stay the same. So your total monthly payment is coming to $1,393.92. That includes your principal and interest, your insurance, your taxes, and your PMI. So that's where that 1393.92 comes to. Now let's talk about the closing costs. So there are two parts to the closing costs. First part of the closing cost is all the closing costs that you will have associated with the loan itself. That includes your underwriting, processing, appraisal, your title costs, your attorney fees, and all that stuff. So that's what the breakdown is here right now. 895 is your origination fee. What that includes is all the credit reports, processing, underwriting, application. We really don't have an application fee. All those are lumped in here. Your appraisal fee is 395. This is the cost that you'll pay upfront. FHA appraisal costs around $395, so that's what that's being shown. Your attorney fee is 450. I'm estimating that. In case you have a smaller amount or a lesser amount, obviously you'll pay less. In your case, I seem to remember you're selling your house as well as buying a new house, so you might get a little bit of price break from the attorney. I'm just estimating 450. This is a third party cost again, so please don't hold that against me because I have no idea what it is going to be, but this is what I see every day. The title services and title insurance, I'm estimating it at $2,000. There's only one mortgage. It includes all the insurance costs that you'll have with the lender policy as well as actually going to the closing cost company and for them to act as your fiduciary agent. So I'm estimating again a $2,000. This is a third party cost, so again an estimation, but a very reasonable. This is what I see on a price, $145,000 home. So we have total closing costs of $3,740. But there's another part to the closing costs. Those are called prepaid expenses. What prepaid expenses are essentially amounts of money that you put in escrow account so that when the bills come due the next year, they will have enough money and enough funds to pay your bills. Prepaid interest for one day, you're going to have to pay prepaid interest for the number of days that are remaining in the month that you're closing. I'm using the least possible amount. The reason I'm doing the least possible because I want to show you that if we have the credit, even if we have only one day of credit, we'll still be able to use the amount that we're getting. So we're using $25. Insurance premium is $14.50. This is 1% upfront MI that FHA charges. So I'm going to put that in there, but we'll come back and show to you that it is being added to the loan amount. Your hazard insurance premium or your homeowner's insurance premium is $780. Again, that was an estimate, but you'll be paying that upfront. And you will also be escrowing that because let's say you close in July, just for example. If you close in July, you're going to put your first bill will be due next year on 1st of July, even though you close in the middle of the July, because insurance companies always bill in advance. And based on your payment cycle, you would have only made 10 months payments and your bill will be due for the entire year. And by law, escrow companies are allowed to keep one extra month because they assume that every month your payment, not every month, every year your payments will go up a little bit. So that's why I'm putting 3 months in there. These are county taxes. I'm estimating around 8 months in there, $2,754. This is based on 459 that we showed you earlier. You are in Illinois, which I'm sure you already know that the real estate taxes are paid in arrears. What that means is when 2011 tax bill comes due in September, it would actually be for 2010. You wouldn't have lived in the house, but you would be the owner of record, so the bill will come to you and you'll have to pay. So the lender is going to make sure you have enough funds to make sure that they have ample funds to pay your bill. So it's $2,754. And it comes up to all these prepaid items: interest, insurance, PMI, and taxes come to $5,204. So now the closing costs actually are a combination of these two numbers, 3740 and 5204. Now we're going to see how much money we need. So our purchase price is $145,000 for us to buy this house. $5,204 is our prepaids. $3,740 are closing costs. So altogether we need $153,944. Again, this is an estimation, not an exact dollar, but a pretty close number. Now let's see, we also have a lot of credits coming back to us. Total loan amount. Our loan amount is a combination of the 96.5% of 145 because we were putting 3.5%, but FHA adds 1%. They give you the option of adding 1% of upfront MI to the loan amount, and that's what I did here, so that your amount of money that you need to bring to the closing is reduced by that. So the total loan amount becomes $141,375. The seller lived in the house in 2010, and since you're going to be paying the bill, they're going to give you the credits for the 2010 remaining months, the 6 month bill. If you close before September, they wouldn't have paid the bill, so you will get that credit, as well as you'll get the credit for the months of 2011 that you didn't own the house and the seller owned it. So I'm assuming around 8 months, $3,672. You'll get that back. If you take these two out, you need $8,897 in cash for you to be able to close on this house. So this is the worksheet that shows no credits from the seller or from the debt negotiators for 3% of closing costs. I'll do another one and I'll show you that how the numbers change. So 145 purchase price, putting 3.5% down, inclusive of all the closing costs, we need around $9,000. So let me show you this, and I'll come back to the other one.